Hello everyone. I will continue with the rest of chapter 7. Now we look at the financial operations of life insurance company. So we look at their balance sheet to start with. So the assets of life insurers have longer duration because it is related to life uh, insurance policy. And many life insurance policies also have a savings component. So the life insurers need to maintain an interest-bearing asset. They also need to maintain separate accounts for interest-sensitive products such as variable annuity. They need to maintain policy reserves as a liability item, which must be offset by assets of equal value. So different states have regulations regarding the minimum policy reserves that a life insurer has to maintain. Then there are reserves for amounts held on deposit. So these are funds which are owed to policyholders and beneficiaries. There is also the asset valuation reserve, which is a statutory account. So it is supposed to absorb any fluctuations in asset value other than due to interest rate. The policyholder surplus is the asset in excess of liabilities, and it is generally less volatile for life insurers as compared to property and casualty insurers. So they have to pay death benefits. They also need to pay annuity benefits, which are their major expenses. And the net profit comes from the revenues collected from premiums as well as uh, subtracting the expenses, dividends, and taxes. So there are a number of measures to uh, determine their financial performance. It can be pre-tax basis or after-tax basis, and it can also be based on the rate of return on the surplus. Now we move on to rate making. We first consider property and casualty insurance. So regulation requires that the rate should be adequate to cover losses and other expenses. The rates should not be excessive and the rates should not be discriminated. That is, individuals with similar risk profile should be charged similarly. From the business perspective, rates should be easy to understand, they should be consistent, they should also be responsive to any change in loss exposure or macroeconomic conditions. And the rate should encourage the policy owners to reduce loss severity and loss frequency. So what is the rate? Rate is the price of insurance unit, and the exposure unit is the unit for insurance pricing. The pure premium is the portion of the rate which can pay for losses as well as adjustment expenses. Loading is over and above the pure premium in order to cover expenses and any contingencies. The gross rate is the sum of pure premium and loading. The gross rate is charged to the policyholder. So the gross rate is multiplied by the number of exposure units. So there are three basic methods to determine rates in property and casualty insurance. The first one is judgment rating. So in this case, individual policies are uh, evaluated by the underwriter and they use their own discretion or their own experience to assign rates. We also have class rating. So in this case, group of policies which have similar characteristics are charged the same rate. So for class rates, we have two methods to determine the rate. One is the pure premium method. So in this case, the total losses incurred plus the adjustment expenses are divided by the number of exposure units. And that gives us an average figure, and that is used as the rate for a particular loss. And in the loss ratio method, actual loss is compared with the expected loss ratio, and the rate is adjusted accordingly for the loss. We also have merit rating. So in this case, individual policies within a class are adjusted based on the individual loss experience. We have a schedule rating where each exposure is individually rated and there is an upward or downward adjustment. In experience rating, the class rate is considered and an upward or downward revision is done based on past loss experience. And in retrospective rating, the individual's loss experience in the current policy determines the rate for the next policy period. Now we look at rate making in life insurance companies. So life insurance companies use mortality table to get the probability of death at different ages. Then this probability is multiplied by the amount to be paid if death occurs. So the company gets the future stream of payments possible at different ages. So these payments are discounted back to the start of the coverage period and the summation is done. That gives us the net premium to be charged or how that premium can be distributed over multiple. So that's all for chapter 7. Thank you.